I was thinking about this the other day. When you sit down to watch a film from like the late 90s or early 2000s.
Oh, yeah. The golden age of very obvious CGI.
Exactly. There was this very specific, almost theatrical expectation of what visual effects were supposed to be, right?
Right. It was an event.
Yeah, it was the alien spaceship hovering over the city or, the dinosaur roaring in the rain.
You could literally point at the screen and say, okay, there it is. That right
Yeah.
there is the VFX budget.
Totally. It was the singular, highly visible thing. It was meant to be the spectacle that they put in the trailer.
Hmm.
But if you step into the modern era of content creation, especially over like the last 5 to 10 years, that old paradigm is just completely shattered.
It really is. It's a completely different world now.
We are looking at a landscape where the visual effects are often, well, entirely invisible.
Yeah, you don't even know they're there.
Right. It's the sky in a period drama. It's the snow on the ground in a romantic comedy, or even just removing a modern coffee cup from a medieval fantasy scene.
Oh, man, the coffee cup cleanup. Essential work.
Yeah. So it's transitioned from being a special feature to just being the fundamental fabric of the medium itself.
Absolutely.
And that invisible architecture, the digital foundation of modern entertainment, is exactly what we are unpacking today for you.
It's a fascinating shift to look at.
It really is. So we're taking a deep dive into a company operating right at the intersection of this shift. They're called Basilic Fly Studio Ltd.
Or Basilic SM, if you're looking at the ticker.
Right, Basilic SSM. And we've got a great stack of sources for you today. We're pulling from their recent financial results, their business updates.
Which had some really interesting numbers in them, by the way.
Yeah, they really do. We also have their FY24 annual reports and various investor presentations that really detail their business model and their industry position.
It's a pretty comprehensive look under the hood.
It is. And the core tension we need to resolve here, the real mission of this deep dive for you listening, is this. Visual effects are the unseen foundation of almost everything on streaming platforms today.
Right. But how does that creative magic actually translate into a durable, scalable business out of India?
Because making beautiful art is one thing,
Exactly. Making a predictable, compounding business out of it is an entirely different beast.
It really is the central question for anyone looking at this space.
Right.
And to accurately gauge Basilic's potential, we really have to throw away that conventional narrow definition of VFX that we were just talking about.
The dinosaur in the rain definition.
Exactly. If you look at this company and just see a group of artists, putting explosions into action sequences, you are entirely mispricing their addressable canvas.
Okay, so how should we be looking at it?
Well, based on the business model outlined in the investor materials, Basilic's market actually encompasses 4 highly distinct pillars.
4 pillars.
Yeah. And each one has its own margin profile and growth trajectory.
Right, and those 4 pillars give us the actual map of their operations, so let's break those down.
The first pillar is the most traditional one, right? It's the VFX services for film, OTT streaming platforms, and advertising.
Yeah, that's the legacy business. That's the direct client work where they are the credited vendor for a specific project.
You actually see their name at the end.
Exactly. But the second pillar is where it starts getting into like the operational plumbing.
The post-production.
Right, post-production. The sources specifically list things like compositing, 2D to 3D conversion, finishing, and cleanup work.
Which is arguably where the most consistent volume lies, isn't it?
Oh, absolutely. It's the essential infrastructure work.
I always think of it like building a high-end commercial property.
Okay, how so?
Well, if traditional VFX is the architectural facade, the shiny glass and steel exterior that everyone looks at and takes pictures of, then post-production and compositing, that's the HVAC systems.
Oh, I see.
It's the plumbing, it's the wiring. The building just cannot function without them, even if the end user never sees the pipes behind the drywall.
That's a really good way to put it.
It is the invisible glue holding every single shot together, making sure the lighting matches, the elements blend, and the scene actually feels cohesive.
Yeah, and that analogy holds up perfectly when you look at how these projects are actually built and executed on the back end.
Okay, so that's 2. What's the third pillar?
The third pillar introduces a completely different dynamic. It's animation and AVGC services.
And AVGC, just to clarify, stands for animation, visual effects, gaming, and comics, right?
Right, exactly. And the sources indicate something really important here. Indian studios are no longer content just being back-end service providers.
They want a bigger piece of the pie.
Yes. They are increasingly participating as co-creators in this ecosystem. They're taking on end-to-end delivery of animated content.
Which I imagine requires a completely different operational pipeline than just, cleaning up live action footage.
Oh, totally. It's a completely different beast operationally.
Okay, so that leads us to the fourth pillar. And the sources suggest this one is absolutely critical for Basilic's specific thesis.
Yeah, this is the big one.
Export outsourcing.
Yes.
We aren't just talking about domestic Indian cinema here at all.
No, not even close. This is the mechanism where global studios and international streamers outsource the heavy lifting to India.
Right. And Basilic serves these international film, TV, and OTT clients not just directly from their Indian facilities, but, and this is key, via a network of overseas subsidiaries.
Yes, that is the crucial detail.
They are capturing demand in Western markets and then routing the execution through their Indian infrastructure.
And honestly, the structural elegance of that fourth pillar cannot be overstated.
Why is it so elegant?
Well, by maintaining a presence in markets like the UK or North America, they can interface with Tier 1 Hollywood clients in their own time zones.
Right, they can take a meeting at 2 p.m. in London.
Exactly. They speak their creative language, they understand the local expectations, and then they leverage the cost arbitrage of the Indian delivery centers for the actual pixel pushing.
So they get the high-end client relationship on one side and the efficient execution on the other.
Precisely. And when you aggregate these four pillars, so direct VFX, post-production plumbing, AVGC co-creation, and export outsourcing, you really begin to see the true scale of their total addressable market.
Yeah, their TAM. Let's actually put some hard numbers to that TAM because the sources throw out some incredibly striking figures.
They do, yeah.
Though they are very careful to caution against taking a single static number at face value, which we'll get into.
Right.
But the results combine domestic demand with that export outsourcing opportunity to project a multi-thousand crore Indian market.
Right.
Specifically, one industry estimate in the materials projects the Indian VFX industry to reach 14,700 crores by 2027.
Which is 14,700 crores is a substantial pool of capital, especially for an industry that was considered a niche cottage sector just a decade ago.
Yeah, it's grown incredibly fast.
But the company-facing presentations take an even wider lens. They look at the broader global AVGC market.
Okay, and what does that look like?
That is targeted to reach $125 billion by 2028.
Wow. $125 billion.
Yeah. And the explicitly stated long-term ambition of the Indian animation and VFX industry is to capture 20 to 25% of that worldwide pie.
Okay, we should be very clear here, though, right? The sources frame this 20 to 25% as a target state.
Right.
It's an industry-wide ambition. It is definitely not the present reality.
No. It's the goal line.
But I think the most crucial takeaway from the sources isn't actually the final number itself.
I agree.
It's the methodology of how TAM is calculated in this specific sector. Because, this isn't like selling consumer packaged goods where you just count the number of households.
Right, you're not just counting heads.
For an investor or an operator in this space, the TAM is highly dynamic. And it is derived from a metric called service intensity.
Yes, service intensity. That concept fundamentally changes how you model growth for a company like Basilic.
Break that down for us.
Well, the mathematical formula provided for domestic film and OTT spend is actually quite elegant.
Okay.
It is the number of titles produced multiplied by the average VFX and post-production budget per title.
Number of titles multiplied by the budget per title, which seems really simple on the surface, right? Volume times price.
It sounds simple, yeah.
But the implications of that are vast. Okay. Because the real market size depends entirely on the visual complexity of the content being commissioned.
Exactly.
If a major domestic studio produces, say, 50 films a year, but they only allocate a tiny fraction of the total budget to post-production,
then the vendor's addressable market is tiny. The volume doesn't matter if the intensity isn't there.
Right. So the market expands through multiple vectors. It grows when total title volume increases, naturally. Right. But the explosive growth happens when the share of VFX-heavy titles in a studio's slate rises, when the per-title visual complexity forces that budget higher,
right,
and when more of that specific work is outsourced to specialists like Basilic, rather than just being poorly handled by an in-house editing team.
Yeah, that is the real engine. And this brings us to one of the most compelling insights buried in the sources regarding market penetration.
What's that?
It's what we might call content density.
Content density, okay.
The data clearly shows that this market is far from saturated. In fact, professional VFX penetration is remarkably uneven across Indian content right now.
Uneven in what way?
Well, you have high-end, tentpole cinematic releases that are utilizing world-class, highly complex VFX pipelines that rival Western productions.
The big blockbusters.
Exactly. But a very large share of regional and mid-tier Indian content still relies on really rudimentary, limited post-production work.
Oh, I see. So that unevenness is the actual opportunity matrix.
Precisely.
The upside for Basilic doesn't rely purely on the Indian entertainment industry just churning out more total hours of content.
No.
It relies on raising the VFX content density of the existing production volume.
Right.
The TAM expands simply by moving a mid-budget drama from, basic color correction and wire removal to premium, seamless visual storytelling.
Yes. It's about increasing the digital pixels per minute of screen time across the board.
Pixels per minute. I like that.
Yeah. And compared to Hollywood-grade production norms, the average Indian piece of content still operates at a lower VFX intensity.
Okay.
The spend per title, and critically the spend per minute of finished content, is well below global premium benchmarks.
So there's a lot of headroom.
So much headroom. Therefore, you do not need exponential volume growth in the number of movies greenlit to see material compound expansion in this market.
Right.
You merely need the existing baseline of productions to upgrade their visual ambition to meet shifting consumer expectations.
But that begs the obvious question, doesn't it?
What's that?
If the addressable market expansion relies on this VFX content density increasing, if it actually requires producers to actively choose to spend more money on post-production, what are the tangible forces pushing them to do that?
Right, because they aren't just doing it for fun.
No, producers don't just volunteer to increase their budgets out of a love for digital art. They want to keep costs down. They are being forced by competitive dynamics.
Absolutely. And the most significant structural driver forcing their hand, without a doubt, is the OTT revolution.
The streaming platforms.
Yes. The streaming platforms have fundamentally rewritten the economic incentives of content production.
And the sources are unequivocal about this.
Totally.
Platforms like Netflix, Amazon Prime, Disney Plus, Ryan, and local giants like GeoCinema, they aren't just commissioning a higher volume of hours.
No, they're demanding a vastly wider variety of genres.
Right, and enforcing a much higher baseline of visual ambition across all of them.
When you look at the genres that historically drive subscriber acquisition and retention on those streaming platforms, you are looking at fantasy, sci-fi, and large-scale action.
Right.
Those are inherently VFX-heavy properties. If a local platform wants to compete for watch time against a global platform's flagship sci-fi series, they cannot put out a product that looks like a low-budget soap opera.
People will just click away.
Exactly. The visual fidelity has to be competitive from minute one.
And it extends far beyond the traditional VFX-heavy genres, too. Yeah, the sources explicitly mention localized premium dramas and crime reconstructions as major beneficiaries of this increased spend.
Crime reconstructions.
Yeah, and I was actually chewing on this point, wondering why a true crime documentary would require a significant VFX budget. Like, it's a documentary, right?
Right. Usually you think talking heads and archival footage.
Exactly. But the logic is sound when you dig into it. If a director is shooting a premium documentary series and needs to recreate a specific neighborhood in Mumbai or Delhi as it looked in 1985,
Oh, right.
they cannot just shoot on location today. The skyline is entirely different, the infrastructure has changed, the vehicles are modern.
They'd have to physically build massive sets, which is too expensive.
Exactly. So they rely heavily on environment extensions. They are digitally erasing the modern world and painting an historical one to maintain that premium feel of the series.
That makes total sense. And the visual complexity of Indian content across all genres is rising sharply to meet this standard.
Yeah.
The sources cite a fascinating array of specific techniques that are rapidly becoming standard operating procedure rather than rare exceptions.
What kind of techniques?
Well, we are seeing widespread use of environment extensions, like you just noted, but also complex de-aging of actors.
Oh, right. So established stars can play younger versions of themselves without having to recast the role.
Exactly. It's super common now. We are also seeing intricate creature work, the deployment of digital doubles for high-risk stunt sequences.
So they don't have to put actors in danger.
Right, and just large-scale action enhancement that simply wasn't viable in local budgets even 5 years ago.
It really represents the total standardization of spectacle.
That's a great way to put it.
The modern audience has developed this subconscious baseline expectation.
Yes, they have.
When you pull out your phone on a commute or turn on your smart TV, you expect a cinematic level of polish, regardless of whether you are watching a theatrical blockbuster or a localized 6-part streaming thriller.
The tolerance for bad visual effects has dropped to zero.
Absolutely zero. Because the global platforms have trained the consumer eye to expect perfection.
Right. And the digital production tools, the rendering engines, and the software pipelines, they have evolved to make this high-end visual treatment more accessible to vendors.
The tools are better.
Much better. But it is the audience expectation that forces the studio to actually pay for it.
Ah, I see.
That dynamic is what constitutes a durable structural shift in the industry's economic model.
Right.
It's not a fad.
Right.
It is a permanent ratcheting up of the minimum viable product for commercial entertainment.
However, while the sources highlight these durable structural shifts, they also note a couple of financial levers that act as distinct drivers for the export side of the business.
Yes, they do.
Specifically, they point to government tax incentives designed to attract VFX outsourcing to India and the overall competitiveness of the Indian rupee against the dollar and the pound.
Now, the sources make a very sharp, necessary distinction here, and it's a framework anyone analyzing this sector must adopt.
Okay, let's hear it.
You have to separate the durable structural drivers from the cyclical tactical tailwinds.
Structural drivers versus tactical tailwind.
Right. Conflating the two leads to huge valuation errors.
Let's pull that apart then. So, global outsourcing is a structural driver, but the currency is a tailwind.
Correct. The trend of Western studios seeking cost efficiency, unprecedented scale, and a deep bench of highly skilled technical talent in India that is a durable structural driver.
Because that need isn't going away.
Exactly. Global studios face relentless compounding cost pressures. India offers a blended delivery cost that is structurally lower.
Right.
It allows a studio in Los Angeles to shift labor-intensive compositing and rotoscoping work across the globe while retaining high-level creative control.
And Basilic's strategy of maintaining a presence in the UK and Canada is purpose-built to capture that durable outsourced demand.
Yes, that is the bedrock of a long-term thesis for them.
Okay, so that's the structural side. But the tax incentives and the rupee valuation are entirely different animals.
Completely different.
Yeah.
They are external variables over which the company has absolutely zero control.
None.
Right. Are government incentives helpful for local production economics and vendor margins? Unquestionably.
Sure.
Does a competitively valued rupee improve Basilic's export economics when they are bidding on contracts priced in dollars or pounds and paying their workforce in rupees?
Yeah, I mean, it provides a very nice margin buffer.
It does. But policy regimes change with election cycles. Currency markets fluctuate based on macroeconomic factors completely divorced from the film industry.
You can't control it.
No. You cannot build a core, decade-long investment thesis purely on the prayer that a government tax break remains permanently untouched, or that foreign exchange rates will always perfectly favor the exporter.
Right, because if they don't,
then the thesis falls apart. They are margin enhancers today, but they are inherently unreliable as core pillars of growth.
Right, like if the rupee suddenly strengthens by 10% against the pound, Basilic's UK contracts instantly become less profitable in local currency terms, assuming they haven't aggressively hedged.
Exactly. The underlying demand for the VFX work might still be there, but the financial realization of that work gets squeezed.
Which brings us to the defining tension of the entire space. It's a duality that the sources emphasize heavily.
Yeah.
The industry is built on these deep, multi-decade structural trends, the shift to digital consumption, the industrialization of creative workflows. But the actual day-to-day, quarter-to-quarter reality of operating a VFX studio is incredibly cyclical and volatile.
It is extremely volatile. It is fundamentally a project-based business masquerading as a recurring revenue platform.
Masquerading, that's a strong word.
Well, the durability comes from the overarching transition from manual post-production to specialized pipeline-based services. The demand for the output is secular, but the cyclicality is vicious, and it stems from the chaotic realities of physical film production and corporate commissioning cycles.
Oh, yeah. Film production cadences fluctuate wildly. OTT commissioning cycles go through aggressive boom and bust periods. Like, we've recently seen major Hollywood studios and streaming platforms go through periods of severe budget tightening.
Oh, absolutely.
Canceling shows halfway through production or pushing slates back by entire calendar years. Projects get rescheduled due to actor availability, strikes, script rewrites.
And when the physical production is delayed, the delivery of the raw footage to the VFX vendor is delayed.
It's a domino effect.
Exactly. And in a milestone-based billing environment, a delay in receiving the footage means a delay in recognizing the revenue.
You can't bill for work you haven't started.
Right. If a major studio decides to push a highly anticipated tentpole release the third quarter of this year to the first quarter of next year, the VFX vendor's revenue recognition profile gets violently shifted right along with it.
Wow, violently shifted.
Yeah, they might have the staff sitting idle, burning through fixed costs, just waiting for the hard drives to arrive.
That sounds incredibly stressful.
It perfectly explains why the financial statements of a company in this sector will often show incredibly lumpy quarter-to-quarter revenue.
So it's not a smooth line up and to the right.
No, not at all. You might witness a spectacular half-year driven by the delivery of 3 major projects, followed by an agonizingly quiet 6 months, simply because the next batch of projects got stuck in pre-production hell.
Okay, so the long-term macroeconomic trajectory of the sector is undeniably up and to the right, but the microeconomic short-term path is a jagged line full of sharp peaks and terrifying valleys.
Terrifying the valleys is right.
Navigating that volatility requires serious operational discipline. So we've mapped out the chaotic waters of the industry. Now we need to look at the captains steering Basilic Fly Studio through them.
Let's do it.
Let's pivot to their management, their track record, and critically, their strategy for capital allocation.
The public profiles in our sources center heavily on R. Balakrishnan.
Okay.
He serves as the CEO and managing director. And the materials indicate he has been the driving force behind Basilic since 2013, taking on the MD and CEO title formally in 2016.
So he's been there a while.
Yeah, his tenure covers the crucial transition period. He's been steering the company from an earlier stage, likely scrappier studio, into a materially larger, publicly listed platform capable of handling international scale.
And the FY24 financial highlights provided in the external summaries and annual reports are definitely designed to reflect that successful growth narrative.
They want to show that trajectory.
Yeah. The headline numbers are undeniably robust. Revenue grew 33.75% year over year to reach 105.79 crores.
105.79 crores in top-line revenue,
Yeah.
representing a 33.75% expansion. That is a formidable growth rate.
Especially in a year where global entertainment spending faced some pretty stiff macroeconomic headwinds.
Exactly. And importantly, the profitability metrics track that top-line expansion almost perfectly.
Okay.
Both EBITDA and profit before tax PBT were up roughly 34%.
So they grew revenue and profit at the same time.
Yes. This suggests they aren't just buying revenue at the expense of margins. They are scaling their cost base relatively efficiently alongside the revenue growth.
Okay, that's a good sign. And the screening data also throws out some operational efficiency metrics that point to a tightening of the ship.
What did you see there?
They highlight a 3-year ROE of 40.6%. Furthermore, their debtor days showed material improvement, dropping from 118 days down to 93.1 days.
Okay, yeah. In a project-led business where client leverage is often heavily skewed toward the big studios, pulling debtor days down by nearly a month is a significant operational win.
It means they're getting paid faster.
Exactly. It speaks directly to their ability to collect on their invoices faster and manage the working capital cycle more aggressively.
But, and this is a big but, there is a defining trait regarding their financial philosophy that stands out immediately in the sources.
Oh, yeah.
And it acts as a very large pivot point for how investors view the company.
I know exactly what you're going to say.
A 0% dividend payout history.
Yep.
Based on the available public record, they have not utilized dividends as a mechanism to return capital to shareholders.
Which forces the analyst to forensically examine their capital allocation strategy.
Right.
If the cash isn't being returned to the owners, how is it being deployed? Where is it going?
And the evidence in the materials points to a strategy singularly focused on aggressive reinvestment back into the business.
Right.
They are using the cash generated from operations to fund internal capacity expansion and organizational maturity.
You see this most clearly in their recent executive recruitment drive.
Yeah, they've been hiring.
They have actively built out the C-suite. They've brought in a chief operating officer, a chief financial officer, a global creative head, along with various heads of studio and production.
It seems like they are clearly trying to transition from a founder-led boutique into an institutionalized corporate structure.
That's the playbook, yeah.
But the reinvestment isn't just going into salaries. They are deploying capital for inorganic expansion as well. The sources prominently highlight a major strategic move: the acquisition of a stake in a UK-based studio called One of Us.
The One of Us acquisition.
Yeah.
That is the most tangible evidence of their export-led platform thesis.
How so?
By taking a stake in a recognized UK entity, they aren't just buying additional revenue, they're buying a prestigious front end.
Oh, I get it. A respected name on the door in London.
Exactly. They acquire a team that already has established relationships with European and Hollywood clients. a team that operates in a favorable tax credit jurisdiction.
So they win the work there.
Right. The strategic intent is likely to use the UK studio to win premium high-margin contracts, execute the high-level creative direction in London.
And then route the labor-intensive volume work back to the delivery centers in India.
Yes, capturing the margin spread.
Okay, that is the textbook bull case for the acquisition. But I think we need to view this through a more critical lens, based on the very real concerns of public market investors outlined in the sources.
We definitely do.
Building out a sprawling C-suite and buying stakes in foreign studios. I mean, it sounds fantastic on an investor relations slide deck.
It looks great on paper.
But without any dividends acting as a tangible return, and without any visible history of share buybacks mentioned in the sources, minority shareholders are essentially flying blind.
They really are.
They are entirely reliant on the management's ability to execute perfectly. They have to trust, with blind faith, that every single crore reinvested into a new CFO or a London studio is actually going to compound and generate a return.
Because they aren't seeing a single rupee in cash returns to validate that growth.
Right.
And that skepticism is entirely warranted. It leads directly into the darker corners of the public record.
Yeah, let's talk about the governance gaps.
The sources highlight several distinct governance gaps and areas where transparency is not fully institutionalized, which just exacerbates the exact anxiety you just described.
So the sources acknowledge there is a baseline of reporting discipline. Like, they publish an annual report, they have independent directors sitting on the board, they employ a compliance officer.
To check the boxes.
Right. They are meeting the statutory minimums for a listed entity. But the deeper, granular details, the details an investor actually needs to model the business and assess risk, are conspicuously missing from the provided summaries.
The most glaring omission, without a doubt, is the lack of detailed segment reporting.
Okay, why is that such a big deal?
Well, when a company operates across 4 different pillars, direct VFX, post-production AVGC, and export outsourcing, each of those segments has a radically different margin profile, growth rate, and risk factor.
They aren't all created equal.
Not at all. So without segment-level disclosure, an external observer cannot tell if the 33% revenue growth was driven by highly profitable export contracts or just low-margin domestic post-production work.
And if you don't know that, you can't really project the future.
You cannot model the future if you don't know the exact composition of the present. They're kind of just guessing at that point.
And the sources also point out a severe lack of robust disclosure around client concentration.
This is a huge red flag for a lot of people.
In a service business, client concentration is the single largest existential risk.
Absolutely.
If a studio is generating 105 crores in revenue, but 70% of that revenue is tied to master service agreements with just 2 global streaming platforms, the entire enterprise is terrifyingly fragile.
Yeah. If one of those streamers changes its commissioning strategy, or alters its approved vendor list, or just decides to enforce a 15% rate cut across the board,
The vendor's margins collapse instantly.
instantly. And without knowing the concentration metrics, the market has to assume the worst.
Add to that the notes in the sources regarding a lack of detailed disclosure on related party transactions, and the opacity surrounding the specific, granular use of proceeds from previous fundraisers.
Right. When a company is aggressively reinvesting capital, but failing to provide granular transparency on where every dollar is going, it inevitably attracts a risk premium from the market.
The market doesn't like uncertainty.
Not one bit.
Now, the sources also provide some specific data points regarding executive incentives and alignment.
Yes, this is interesting.
The visible data shows the CEO's compensation is situated around 1.2 crores. Furthermore, the screening data indicates that the promoter holding has recently decreased by 4.58%.
Okay, so while the organizational structure is undoubtedly becoming more scalable with the influx of professional C-suite hires,
Right.
the combination of these factors, the compensation structure, the slight reduction in promoter holding, and the overarching opacity in reporting it, suggests a company that remains highly founder-centric.
Okay.
They are making the necessary moves to professionalize the exterior, but the core operational dependency still rests heavily on the founder's ability to navigate the industry.
So we're presented with this incredibly complex, contradictory mix of signals.
It's a real puzzle.
On one side of the ledger, you have phenomenal top-line growth, surging past 100 crores with a 33% jump. You have a 40.6% ROE. You have strategic inorganic acquisitions in the UK, positioning them for global scale.
That's great.
But on the other side of the ledger, you have a complete lack of dividend payouts, 0 segment reporting, unknown client concentration risks, and a founder-centric structure navigating a highly cyclical industry.
It's a lot of risk to weigh.
This dichotomy creates a fierce, ongoing tug of war in the public markets. How are onlookers actually pricing this volatile journey?
The prevailing market narrative, as distilled from the sources, is quite telling.
Yeah.
The market absolutely does not view Basilic as a safe, stable, slow and steady content services compounder.
It's not a sleepy infrastructure play.
Not at all. They do not look at this stock as a utility company where you can just park your capital and steadily clip coupons.
So how do they view it?
The market views it as a small, high beta growth story.
High bait.
Yeah. It is a narrative deeply fraught with execution risk and balance sheet risk. The stock exhibits depressed technical sentiment and high volatility.
It bounces around a lot.
It does. It trades at a valuation multiple that suggests investors are heavily discounting the reported growth.
They don't quite buy the smooth story.
Right. They're not fully pricing in a clean, uninterrupted compounding path because they simply don't believe the path will be clean. They're waiting on the sidelines for undeniable proof of execution.
Okay, let's dissect the two opposing sides of this market tug of war. Let's start with the optimistic view, the bull case.
Sure.
The sources describe this as the export-led platform thesis.
Right. The core of the bull case is that Basilic is perfectly positioned to act as a significant beneficiary of industry consolidation.
Consolidation. Okay, explain that.
Well, as smaller, undercapitalized VFX shops struggle to maintain the technology infrastructure required for modern rendering.
Because the servers are expensive.
Very expensive. Or if they fail to secure the working capital needed to survive Hollywood strikes and delayed commissioning cycles, they will inevitably fold.
And when they fold?
Basilic, with its public market currency and growing scale, absorbs that displaced demand.
Ah, I see. But that consolidation thesis relies on a very specific sequence of events playing out flawlessly, doesn't it?
It absolutely does.
First, they need to demonstrate a consistently rising export mix. The domestic market is great for volume, but the export market is where the margin expansion lives.
Right, the UK and North American contracts.
Yeah. They need to prove they can not only win, but retain repeat business from the massive global studios.
Because winning a single contract for one sequence in a Marvel movie is a great PR win.
Yeah, you put it on the website.
But becoming the preferred embedded vendor for an entire slate of Disney Plus shows is how you actually build a business.
Exactly.
And critically, the bull case hinges on the market seeing tangible evidence of operating leverage. As they scale from 100 crores to 200 crores in revenue, the market needs to see that the fixed costs of maintaining the server farms, the software licenses, and the core management team are absorbed more efficiently over that larger revenue base.
Which would lead to outsized margin expansion.
Exactly.
That's the dream scenario. They become the indispensable, highly efficient pipeline for global streamers.
Yep, that's the bull case.
But the pessimistic view, the bear case, paints a much bleaker picture of the underlying mechanics.
It really does.
The bear case essentially views Basilic as a fragile, lumpy project business, desperately trying to project the image of a tech platform.
And the bear arguments are anchored in the structural realities of the service vendor ecosystem.
Right.
The primary concern, as we discussed, is client concentration. But it goes deeper than just revenue risk.
Where else does it go?
It's about pricing power.
Okay.
The global VFX industry is notorious for vendors possessing incredibly weak pricing power.
Because everyone is bidding for the same jobs.
Right. If every major studio in India, Canada, and the UK is fiercely competing for the same pool of outsourced post-production work from Netflix or Amazon, it rapidly degenerates into a race to the bottom on price.
Yeah, if you are relying on cost arbitrage as your primary competitive advantage, there is always someone willing to do it a little bit cheaper.
Always. If you can't dictate terms based on unique, creative, proprietary tech, you are just a price taker. You accept whatever margin the client graciously allows you to keep.
Exactly the danger.
Then you compound that weak pricing power with immense execution risks.
What kind of execution risks?
Well, what happens if there are technical failures? Or if the client repeatedly demands creative revisions that fall outside the original scope of work?
Oh, scope creep. That's a killer.
It leads to severe delivery delays.
And delivery delays in a milestone billing business lead directly to the market's biggest fear, working capital strain. The bear case heavily scrutinizes the relationship between cash conversion and profit growth. They are looking at the P&L and seeing 34% PBT growth, but they are terrified that the reported profits aren't actually turning into unencumbered cash in the bank.
Right, they worry the cash is just trapped.
They worry that every rupee of profit is just being immediately plowed back into funding the extended working capital cycle of the next big project, leaving the company constantly starved for actual liquidity.
It is the classic trap of a fast-growing, capital-intensive project business. You can grow yourself right into bankruptcy if you don't manage the working capital cycle with absolute precision.
So for anyone listening who is trying to handicap this situation, trying to figure out whether the export-led platform bull case or the fragile project business bear case will ultimately win out over the next 24 months.
The sources provide a definitive checklist.
Yeah, a litmus test of specific metrics to watch in the coming quarters. Let's run through them.
First, you must watch the quarterly revenue growth trends. Is the growth sustained across multiple quarters, indicating a robust pipeline of diverse projects?
Or is it highly erratic, suggesting reliance on one-off mega projects?
Exactly. Second, you must monitor the receivables movement. Even with the improvement in debtor days, are they actually collecting cash, or are receivables piling up on the balance sheet?
Third, you have to look for any improvement in management disclosure.
Especially regarding segment reporting and the export mix.
Right. If they start breaking out the revenue and showing that the high-margin UK subsidiary work is growing at 50% year over year, the market will reward them.
But if they keep the segments blended and opaque, the market will assume they are hiding margin degradation.
And finally, you have to watch for margin consistency. Can they maintain that 34% EBITDA growth when the rupee inevitably fluctuates or when the next industry strike halts production?
It really is akin to analyzing the viability of an independent film studio.
I think about that comparison constantly.
That's a good one.
If you invest in an indie studio, the box office hits, the top-line revenue can look absolutely spectacular on the front page of the trade magazines. You see a huge opening weekend and think the studio is printing money.
But that's just the surface.
Right. If you want to know if that studio is actually building a durable legacy, if they are going to survive to make their next 50 films, you completely ignore the box office gross.
You dig into the production budget overruns.
Exactly. You scrutinize the casting contracts and the back-end points they gave away. You look at how they manage their working capital and their reliance on a single blockbuster director.
The headline numbers generate the hype, but the actual durability of the enterprise is entirely found in the unglamorous operational plumbing.
That is the perfect framework for evaluating Basilic. The 33% revenue growth is the box office hit.
But the working capital management, the client concentration, and the segment margins are the operational plumbing that will determine their survival.
Well said. We've covered an immense amount of ground today for you. We've navigated the shifting definitions of visual effects, deconstructed the 4 pillars of Basilic's addressable market, analyzed the profound structural forces driving the OTT industry, and meticulously balanced the bull and bear arguments surrounding their execution strategy.
It's a complex picture.
It is. But before we wrap up this deep dive, I want to leave you with a final, highly provocative thought.
Okay, what is it?
It's a concept not directly explored in our financial analysis today, but it was heavily inspired by a single line buried in the sources.
Which line?
The materials mention the industry's ongoing structural shift from manual post to specialized, pipeline-based production services.
Ah, yes. The relentless industrialization of the creative process.
Exactly. They are turning art into an assembly line. But it makes me wonder about the ultimate horizon of that trend.
Where does it end?
Right. As artificial intelligence, machine learning algorithms, and automated generative rendering technologies become exponentially cheaper, vastly more sophisticated, and widely accessible to anyone with a high-end graphics card.
Oh, I see where you're going with this.
Will the entire cost arbitrage business model that currently favors offshore delivery hubs like India eventually face a catastrophic existential threat?
It raises a profound, unavoidable question about the future value of human creative labor in a specialized pipeline.
If a major studio in Hollywood can eventually leverage an in-house, heavily trained AI-driven pipeline to execute the compositing, generate the environment extensions, and handle the tedious 2D to 3D cleanup work.
Instantly, locally.
Yes. Without needing to employ a large team of thousands of artists, does the future of the VFX industry actually belong to the most efficient, cheapest delivery center located on the other side of the world?
Or does it belong entirely to whichever tech giant owns the most efficient, proprietary, generative algorithm sitting on a server rack in Burbank?
That is the ultimate endgame question. Will technology eventually progress to a point where it completely erases the geographic cost advantage that companies like Basilic are currently built upon?
It's something you have to factor into any long-term view of this sector.
Absolutely. So, next time you sit down to watch a premium streaming series, do not skip the credits. Let them roll.
Read the names.
Look at the sheer volume of names. Look at the myriad of international studios listed, and think about the incredibly complex, globally distributed, and highly cyclical business model that is churning away 24/7, managing thousands of artists and massive working capital cycles, all operating behind every single invisible digital environment you just watched.
It genuinely changes how you perceive the screen.
It absolutely does. Thanks for joining us on this deep dive into the hidden architecture of visual effects and the strategic tightrope of Basilic Fly Studio. We'll catch you on the next one.